What if I told you there was a hidden market in Australia valued at over 85 billion? It can average returns of 10% a year, which is much higher than the housing market or most super funds. And it's actually safer. The problem, 4 out of every 5 of these deals happen behind closed doors. The data is closely guarded. There is very little information online, and historically, the average investor does not have access to it. Now, things are changing. So, what market am I talking about? It's not stocks or cryptocurrency or some get-rich-quick scheme. I'm talking about commercial property. That's right. Offices, industrial facilities, retail spaces. These might sound boring, but this is where you'll find stability, security, and huge incomes. Hi, I'm Anita. I have a combined 20 years of experience in the industry, both as a commercial buyer's agent, helping investors navigate the market, and as a registered construction and property lawyer, dissecting the details of contracts and leases. I've been on the inside, and I'm passionate about getting everyday investors into the world of commercial property. In this video, I'm going to answer 1. Why you should be looking at commercial property as an investment. 2. How much money could this investment actually make you? 3. How can you secure financing to set yourself up for success in the world of commercial investing? Plus, be sure to stick around until the end to find out where to get insider knowledge that the big companies will never release. So, let's get into it. The housing ceiling. Everyone knows Australia is one of the most valuable property markets in the world. For years, just buying a house and letting it grow in value was enough to set yourself up for retirement. Take a city like Melbourne, where the Melbourne house price went up from $12,800 in 1970 to $953,000 at the end of 2025. Even after adjusting for inflation, that's an increase of over $414,000. This is why 2.2 million Australians have an investment property on top of their principal home. But this is where most people get stuck. After 2 properties, the number drops off a cliff. A big reason is that most people reach their borrowing capacity at this point. Banks stop lending to them. I'll come back to this and tell you how you can get around it a little bit later. You are probably looking to set up a nice retirement for yourself, but how much do you actually need? The ASFA recommends having at least $54,000 a year for a comfortable life as a single person. So if you retire at 60, live to 80, you'll need about $1 million. In reality, at that age, the average Australian only has about $350,000 in their super. And since COVID, real wages have plummeted compared to the CPI, meaning your super is taking a hit too. That's why you need to get more aggressive about your investment. You need to find a way to generate more cash flow, and you need to take control of your money. But it doesn't have to mean taking huge risks. You may have spent your 20s buying an investment property or two, and I know some say that your 30s are when the fun stops. The next step is commercial property. But what makes it so different to housing? Going commercial. Plenty of experts will tell you that renting out houses is one of the best ideas for passive income. Housing is on high demand and there are tax deductions available, and income is fairly steady. This might surprise you, but after council rates, land tax, and everything else, the average net income on residential property is just 1 or 2%. Plus, residential property isn't always low-risk strategy. One reason is emotion. Home buyers value the feeling that they get when they first walk into the door. It can be a gut feeling decision. That's why renovation and house flipping can sometimes increase house selling price a lot. There's an entire reality TV show about it, but it also makes the market much less predictable. If you want a more scientific, stable investment, it's time to look at commercial property. That 1 to 2% figure I mentioned before, when it comes to commercial property, that number jumps up between 5 and 7%. In fact, between 1986 and 2016, the average annual return on commercial property was even higher at 10.4%. If you're still not convinced, here's another chart. This one compares the growth of the commercial property against residential over the last 2 decades. You can see that while residential is down at 154%, agricultural property is way up there at 256%. That's an average growth of 13% per year. But before you throw your hat into the commercial property world, there are a few things you need to understand. The most important is commercial lease structures. That is what determines who is paying for what. Here's a brief rundown of 3 main types. First, gross lease. Just like with renting a house, the tenant still pays for the rent, the utilities they use, and the subscriptions they take. They don't pay any outgoings. That means things like council, taxes, strata fees, building insurance, property management, pretty much everything that comes with owning and operating a building. For a tenant, this is the simplest and most predictable structure, but as a landlord, it's usually not the most beneficial. That's where the second option comes in, the semi-gross lease. This is where risk is shared between the tenant and the landlord. Semi-gross leases come in 2 forms. 1, using a base rate, or 2, a clearly defined split. Number 1 means choosing a base year. Say the outgoings of a property increase from $15,000 to $16,000 between the base year and the current year. The tenant would then pay the extra $1,000 as the outgoing increases. As a landlord, this helps minimize your exposure to operating costs going up. Number 2 is where specific costs are decided to be paid for by the tenant, like water or council rate. But these vary from contract to contract. And finally, net lease. There are 3 types of net leases: single net, double net, and triple net. These are a sliding scale of how many outgoings the tenant pays for on top of the base rate, all the way up to triple net, which covers basically everything. That means as a landlord, you can set and forget, sit back and let the tenant handle all the bills. These 3 types are just the basics. There are thousands of ways of slicing up a commercial tenancy agreement depending on the sector, the building, the state, and a ton of other factors. This gets complicated quickly, but complications means big opportunity if you know what you are doing. Remember, the key advantage of commercial property is stability. You are dealing with businesses, not individuals. They have budgets, accountants, and generally much more income. Legally, the rights of the landlord and the tenants are much more balanced too. Many contracts include annual rent increases or are tied up to the consumer price index. Plus, leases by businesses are much more longer. For example, in Victoria, the Retail Leases Act states that the minimum lease period is 5 years. So higher returns, tenants paying most of the expenses, more rights, and long-term contracts. What's not to love? The next step is assessing whether you have enough money to get into commercial property. There's no getting around it. Commercial property is for serious investors. I mean, investors who are looking to boost their cash flow and carefully maximize their growth. Still in? Great. There's just one more thing you need to know before getting into commercial investing, and it's the most important part. I'm talking financing. First, let's look at the loan to value ratio, or LVR. In commercial property, these usually range from 60 to 70%. That means the target to get into the game takes around 30% deposit. That's much higher than residential property, which can be as low as 5%. So, on a 1 million commercial property, you will need between 250 to 300,000 in savings or equity. Remember how I talked about reaching your borrowing capacity? Fortunately, lenders usually only look at the commercial lease, meaning your residential property debt won't come into the equation. And there are huge opportunities once you already own commercial property. A relatively small upgrade can boost the value of the property enormously. Let's look at an example. Say you take over a warehouse that's rented out at $200 per square meter. If you install a mezzanine, you could increase the net lettable area, also known as NLA. A 50 square meter mezzanine, that's an extra $10,000 of net rent per year. You could also choose to divide your property, which is much easier than dividing in the residential world. You might be thinking, how do you go about finding commercial property? Usually, you can't just browse property on real estate websites and show up to an inspection. Not all properties are marketed online. And even if you do find one, before you commit to buying, you need to know the technical differences and whether the property has any hidden issues. As you probably learned by now, it all comes down to the details. The contract terms, deal structures, whether the property is fit for purpose, all the way down to the lease structure that we already talked about. There are a lot of moving parts. That's where I come in. I'm your commercial expert with 2 decades of experience working in the industry. I comb through the details that even seasoned investors can find confusing. My company, CRE Wealth, will walk you through the entire process step by step. Risk tolerance, property selection, due diligence, all in a tailor-made premium service built around your needs. We also have free tools to use on our website, like a cash flow calculator. So check it out. If you want to know more, links are in the comments below, or head to crewealth.com.au to set up a free consultation. If you aren't quite ready to make the plunge yet, that's fine, but at least make sure you're subscribed to this channel. I'll be dropping property insights and market analysis you won't get anywhere else. See you in the next video.